Hello everyone! Today we're diving into the 7 common 401k mistakes you should avoid. We'll explore why maximizing your 401k is essential for a comfortable retirement, and I'll give you actionable steps to fix these mistakes today. Make sure to check out the resources in the description below for more ways to generate income. Let's talk about employer matches. This is free money, people. It's like getting a bonus just for saving for your future. Seriously, if your employer offers a match, contribute at least enough to get the full amount. Don't leave that money on the table. Imagine turning down a 100% return on your investment. That's what you're doing if you don't snag that match. It's like saying no to a raise. Let's say your employer matches 50% of your contributions up to 6% of your salary. If you earn $60,000 a year, that's a potential $1,800 in free money. You'd be shocked how quickly those matching contributions add up over time, especially with compound interest working its magic. Trust me, you'll thank yourself later. Fees are like those pesky fruit flies that show up uninvited and eat all your bananas small, but they can really add up over time. We're talking about those sneaky administrative and investment management fees that can eat into your returns. Remember, every dollar you lose to fees is a dollar that isn't growing for your retirement. Now, I'm not saying all fees are bad. You're paying for a service, but you want to make sure those fees are reasonable. Take a close look at your 401k plan documents or talk to your plan provider to understand the fee structure. If the fees seem high, consider switching to lower-cost index funds or even talking to your employer about exploring other plan options. Diversifying your investments is like having a balanced breakfast. It sets you up for success. You wouldn't just eat cereal every day, right? You'd want some fruit, maybe some eggs for protein. It's the same with your 401k. Don't put all your money into one stock or one asset class. Spread it around. Invest in a mix of stocks, bonds, and maybe even some real estate or international funds. That way, if one area of the market takes a hit, your entire portfolio won't go down with it. Remember, diversification is your friend when it comes to managing risk and maximizing returns in the long run. This one's crucial, guys. Make sure your beneficiary information is always current. Life throws curveballs, and you want to ensure your hard-earned money goes to the right people if something happens. Imagine spending years building your nest egg, only for it to end up in the wrong hands because you forgot to update a form. It's a simple step, but it can save a lot of headaches and heartaches down the road. Take a few minutes to review and update your beneficiary designations regularly, especially after major life events like marriage, divorce, or the birth of a child. Trust me, it's worth it. Borrowing from your 401k should be a last resort, kind of like calling your parents for money after you've already sold all your furniture on Craigslist. It might seem tempting, but it can have serious consequences for your retirement savings. When you borrow from your 401k, you're essentially borrowing from yourself and paying yourself back with interest. Plus, if you lose your job, you'll likely have to repay the loan in full, often within 60 days, or face hefty taxes and penalties. Instead of raiding your retirement fund, explore other options like cutting expenses, finding ways to earn extra income, or looking into personal loans with potentially lower interest rates. Would you drive your car for years without ever getting an oil change or checking the tire pressure? Probably not. Your 401k deserves the same level of attention. Life changes, goals evolve, and the market has its ups and downs. It's crucial to review your 401k portfolio periodically, at least once a year, to ensure your investments still align with your risk tolerance and retirement goals. Make adjustments as needed, rebalance your portfolio, and consider talking to a financial advisor if you're feeling lost or overwhelmed. Remember, a little maintenance can go a long way in keeping your retirement savings on track. Listen up, future retirees, because this one's for you. A Roth 401k could be your secret weapon for tax-free retirement income. Unlike traditional 401k contributions, which are tax-deductible now but taxed in retirement, Roth 401k contributions are made with after-tax dollars. The beauty is, when you start withdrawing in retirement, those withdrawals are tax-free. If you're young and just starting, your income is likely lower, and you're in a lower tax bracket, making a Roth 401k a no-brainer. Even if you're further along in your career, it's worth considering a Roth 401k, especially if you anticipate being in a higher tax bracket in retirement. Don't forget to like, subscribe, and check out the resources below to learn more about boosting your income. Remember, building a solid retirement fund is a marathon, not a sprint. By avoiding these common 401k mistakes, you'll be well on your way to securing a comfortable and enjoyable retirement. Stay financially savvy and keep building that nest egg. Hope you enjoyed the Happy Tunes.